Okay, we continue with our earnings analysis, and IDFC FIRST Bank is in focus. It reported a weak set of numbers compared to what the market was expecting. Net interest income and profit after tax came in below CNBC TV18 polls, while FY25 credit cost ratio was above even the company's own guidance. However, the non-MFI stress was stable quarter on quarter, and that is a very big positive. To discuss these and more, we have with us the big man himself, Vaidyanathan, Managing Director and CEO at IDFC FIRST Bank. Good morning, Mr. Vaidyanathan. Thank you very much indeed for your time. Actually, the market is worried about both stress and income because the numbers came in adverse. Can you first tell us about this whole credit cost issue? It's high. How do you see it going? It's higher than the guidance.
Well, actually, it's playing to script. Let's be very, let's put the numbers out properly out there. 2.45% is a credit cost for this year for the bank. And this includes the impact of the MFI and also includes the impact of that Mumbai entry point toll road issue, which is a legacy, the infrastructure account. If you take this thing out, because we'll talk about them separately, it's only 1.76%. And our gross NPA is holding up at about 1.87%. Net NPA is 0.83%. In credit cost, to complete the picture, is 1.76%, excluding those two items. So actually, this is, like you rightly pointed out, that our MFI has been higher, but our core book, that's really good news, that it's very stable.
Okay. Would you say the worst of MFI stress is over?
Yes. Which, we should be very watchful. It's a very sensitive segment. I want to be really watchful. But let me just say that, as we had said the last quarter, I had spoken at your channel also, we had said that Q4 will be the peak of provision. And then we said in Q1 should be less than Q4, and Q2 and so on progressively. We feel definitely it's progressing on this direction as far as the eyes can see. And best part of being able to establish that is the SMA pool, because SMA feeds to NP and provisions and all that. So our SMA pool has come down from 777 crores to 640 crores. So that is SMA 012 put together for MFI. The whole block has come down. So naturally, in the subsequent quarters, provision should come down.
Okay. Can you take us also through income? Your costs are high, obviously, because you're building the bank. But income has also kind of faltered. What kind of, income growth or interest income growth can you, guide us?
So income also, this MFI thing is affected on two fronts. We talked of credit costs. I don't repeat that because it is higher than expected. I also agree. It was high. But coming back to, but frankly, that happened to all the 200 players who played in this market. We are not the only players. But the other impact of MFI also was income, because we shrank the book, just for the record. We shrank the book of 13,500 crores as of March 31, 2024. So 9,500 crores is a big dip of 44,000 crores. So that also brought down income with it, because the yield on this book was like 23-24%.
So it's an interest reversal, is it?
No, the book shrank. So you accrue less income, like I told you, numbers. So basically the book, so composition of MFI in the book has come down from 7% 1 year ago to now 5 point some, maybe 4.8% now. Next year will come down to 3%. So net, we have ambitions of being, a large bank. We don't want to forever be in the mid-tier bank. We want to be a larger bank category, and MFI cannot be a big portion of a book. So that is a phenomenon playing out. But to estimate the next year, let me put it like that, to your question. So we expect our OPEX to further moderate next year. Our OPEX growth last year was only 16%. Next year we're guiding to be like 13%. So OPEX coming down is a very material movement that should impact the operating profit and the PAT of the bank next year. But certainly short point is that we expect that 26 numbers of PAT to be much, much better than 25.
Actually, you took away my next question. I did want to talk to you about OPEX. Over 4,000 crores, right? Now, this near almost 5,000 crores. 4,991 is the OPEX. Now, this is like, pretty close to, say, Kotak's OPEX or something. And they have many, many more branches. So what explains such a large OPEX? And when will you be able to milk it? Because that also means cost to income is among the highest in the industry.
Yes, that's absolutely correct. So basically, we added, Lata, we had 200 branches 5 years ago. We have 1,000 branches now. We had 200 ATMs. We have 1,100 ATMs. We hired the people. We put up the infrastructure, the whole thing. We start up so many lines of businesses like cash management and FASTag and credit cards and the liability franchise, the current account. It's a new bank coming up. All things had to be spent. So that's the way it is. So, but the good news is that now incremental, let me just tell you 4 numbers. It will help you very easily to understand. YOY growth on OPEX for Q1 of last year was 21%. Q2 YOY growth was 18. Q3 was 16. Q4 is 12. You can clearly see we are really clamping down on OPEX now. And next year, we expect this to be only about 13%. So we are really going after OPEX, and there are many ways of going after it. And that, we believe, is a material reason why our PAT also should look up next year. The other thing, Lata, is that I want to just put the correct numbers in front of everybody so that it's very clear to expect from us. While the loan book next year may grow up by about 20%, income growth will be like 14% because the microfinance component as a percentage will come down. But income comes down, income grows at a slower pace, but OPEX also grows at a slower pace. Operating profit will still improve next year meaningfully.
Okay. So the slowdown in income growth will be countered by the slowdown in OPEX growth as well, is what you're saying.
Absolutely.
Right?
And the year after that, now the bank is really well set because the machine's running, good franchise, good brand, all that has come. Now, when you look forward, let me say just 1 year forward, I don't want to get too far away, but let me say 27, we expect the income, OPEX to still grow only by that zone, like 13%, but we believe income will go up by 18 because by that time the microfinance would be in the base case itself. So I really expect that 27 to be materially improved and 26 also to be much better than 25.
Okay. But that also because you're stressing less on microfinance, your margins are coming down. I mean, you were 6+. Now you are a little short of 6% in terms of margins. What's the trend? If that will go down, then that again hurts income, hurts ROA.
No, it's true. Absolutely, you're right. You called it right. So the way we look at, I'll just put the numbers out to just put some clarity on this. So on the margins front, last quarter, which come down to something like 595, as we progress to becoming a large bank, I told you our ambitions of becoming one of them. So there'll be some sort of a moderation there. But let me give you a next 1 year picture. So we expect the repo rates to already come down to 25 basis points last quarter. We expect another 50 basis points to happen. So to the extent we have 30% of a book is linked to repo, we do expect the income to dip according to that amount. But good thing is that we're also going to cut the cost of deposits. Only today, might be just fresh off the press, we brought down our interest rates on fixed deposits to as low as the large banks. Okay. It's a very material development for us, like as low as the big banks. And, it was like a 200 basis points more than those banks 3, 4, 5 years ago. It's now like match the rates. So when we drop the rates also, this also will come down. But together, impact on margin next year should be 10 basis points over Q4 of FY25.
So 5.85 is what we should be prepared for, you're saying?
For next year, vis-a-vis 595 of this year.
Yeah, no, I see, that is understandable. You cannot always be at the 6% mark. But ultimately, as your OPEX, everything will crystallize in the ROA. So give us an ROA guidance. That also has fallen, which may, that perhaps explains why your stock is down 1.2% on a day when the market is up. The ROA would be a disappointment. What would your guidance be?
So we believe that by end of this financial year, we should go back to the 1% kind of a leak. And I agree, it's like 0.3, 0.4%. We had that twin impact, right? Income came down, credit cost went up. This is a strange combination of events came together from MFI. As the impact of MFI recedes over the next 4 quarters, ROA should come back to 1% is what we are working towards.
Okay. Do you release some money because of the lower LCR rules, especially in wholesale and even in retail, lower than at least the draft?
Well, it's much better than the draft guidelines. in the draft guidelines, as per them, it is much benign because the draft guidelines, we had to put out 10,000 crores of extra cash to meet LCR. In the new guideline, our expectation is about 1,000 crores. So it's like markedly better. And 1,000 crores for a big bank like us is really nothing, or for a size of our bank, really nothing. Think of it like 1 or 2 basis points.
Oh, that's excellent. So that also reduces costs or at least improves margins in a big way. You have more money to lend to more profitable areas. So give us a guidance in terms of growth. Okay, the other vertical. What is the vertical you see giving you growth now that you've pulled back a little from microfinance? Will it be SME, MSME? What is your growth lever?
So there are 4 segments we work with. One is the retail segment. Second is the SME segment. Third is the commercial segment. Commercial is the sitting between SME to the large corporate, that commercial segment. The fourth is the corporate segment. And fifth is the agri segment. Think of it like these 5 sectors. And there will also MFI. So we will, of course, mute MFI because, like I said, we don't want to be hostage to one product holding the bank hostage to numbers. So we will mute that. But all other businesses are set for growth. In fact, since I'm on a channel, let me also say that we are looking to build a commercial banking team, the one that sits between the small corporate and large corporate. And we are looking to build a proper team there. So anybody hearing the program want to reach out to us for a proper role, I'll be happy to.
Okay. But just a final squeeze in a question, though, we are being warned of end of time. Your cost per branch. Now, I have not done this math. It has come from someone who's watching this show and is sending the question. He says your cost per branch is as high as 19 crore, whereas for ICICI, HDFC Bank, Bank of Maharashtra, it's much lower at about 6-7 crores. Any reason why your branch, first of all, is this number right? Is your branch cost that much higher than your previous employer, ICICI? And why?
No, my previous employer is a great bank. But let me just say that these numbers are not are absolutely wrong. Actually, very misleading way of comparing banks, actually, because cost per branch is pretty much the same like every other bank, except that we are less branch-heavy bank. We have only 1,000 branches, and we are originating 50,000 crores a year of deposits because our digital machinery is running a very big way. And then we have so many other businesses that are running. Like imagine there's a card business. If you go load the card OPEX or a cash management OPEX onto a branch, how does it make sense? So these numbers are not exactly the right benchmark. The real thing is the bank has many new lines of business launched, which we had to do, and they all have a cost. So they have to look for their own independent paybacks and stuff, and they should not, you should not load them to a cost of a branch. A branch cost is similar to other banks.
Okay. Your previous great employer, KV Kamath, spoke to me recently. And, as he looked into the future, he said banks, given the way in which fintechs have come in and, technologies coming into NBFCs, he said banks will have to cut their their cost to income to 1/4 their current number. And he was looking at, ICICI and saying they have to go down to 15%. Give us some guidance. What does your cost to income is sitting at 75? Where does it go to, say, in 2 years, in 3 years?
We think that a good, stable cost income of today's modern times, at this point of time, I agree with Mr. Kamath about the longer picture. But for now, it's more like the 50s, 40s, 50s, let me say late 40s kind of stuff.
Okay.
So we have no doubt that we will get there. Like, we have zero doubt because it's just a skill. Nobody should forget. It's a 5-year-old bank or a 6-year-old bank. Those banks are 25, 30-year-old banks.
Yes.
You really can't compare. But when markets are markets, they always compare. So in the long run, I have no doubt in my head that we will get there. And I'll give you one number about how technology is really helping Tata in this cost to income ratio. Last year, we added only 58 branches. But our deposits went up by 25%. That is, we grew the branches by 7%, deposit up 25%. This year, we're planning to add branches only by 10%, but we expect deposits to grow by 23, 24%.
Yes.
So the power of technology is really showing at our bank, and we believe it will be material progress for the bank in the future. And finally, it's also helping a customer experience.
Okay. No, there's no taking away that everyone who looks at your bank is impressed by the deposit growth, even under very difficult circumstances. So take your point of that, and congratulations for that. Thank you very much for joining us, Mr. Vaidyanathan. Out of time, we have to wrap up on Bazaar. On that note, the market's still in very high spirits. Chartbusters will take the action forward.